Higher gasoline and diesel prices are now costing the American economy an additional $500 million every single day. Not per month, not per quarter, per day. And that number is still climbing. Since late February, when U.S. and Israeli strikes on Iran triggered the most significant Middle East escalation in decades, the price of oil has surged more than 50%. The Strait of Hormuz, a 21-mile-wide choke point that carries roughly one-fifth of the world's crude oil and liquefied natural gas, has been effectively shut down for the first time in recorded history. Brent crude is now trading above $110 a barrel. 3 weeks ago, it was $70. But the number on the gas station sign, that's actually the smallest piece of what's coming. There are 4 more waves of price increases heading toward your wallet right now, each one bigger than the last, each one operating on a different timeline, and most people won't see any of them until it's far too late to prepare. What I'm about to walk you through isn't just what's happening to the economy. It's why your mind is actively working against you right now, and exactly what that's going to cost you if you don't override it.
Let's start with what you can already see. Gas prices. The national average has jumped from under $3 a gallon to $3.70. In California, drivers are paying over $5.30. And diesel, the fuel that powers the 18-wheelers delivering literally everything you buy, has surged 36%, approaching $5.10 a gallon. The average American household spends about $2,500 a year on fuel, roughly $50 a week. If you're suddenly paying $10 or $15 more per week, that doesn't sound catastrophic on its own. So your internal threat assessment system files it under annoying but manageable and moves on. That filing is wrong. And the reason it's wrong reveals something important about how we process financial danger. Psychologists use a concept called mental accounting to describe the way we unconsciously divide our money into invisible buckets: gas, groceries, entertainment, savings. When one bucket suddenly overflows, we don't sit down and calmly redistribute the money. We emotionally react. We slash whatever feels optional. Dining out disappears. The gym membership gets canceled. That trip you were planning quietly evaporates. The investment contribution you told yourself you'd increase this year, it stays exactly where it is. The chief economist at the National Retail Federation has confirmed this pattern repeatedly. When gas prices spike, the first casualties are experiences, restaurants, movie theaters, theme parks. Not because those things got more expensive, because your survival instinct reclassified them as luxuries the moment a mandatory expense jumped. And that instinct is about to get a lot louder.
Because gas is just wave 1. Nobody is framing this correctly yet. The war's economic impact isn't a single price spike. It's a rolling sequence of shocks arriving on staggered timelines, each one compounding the damage of the last. By the time most people recognize the full picture, 4 of the 5 waves will have already hit. Wave 1, gas. You already know this one. It showed up within days. Wave 2, groceries. This one is landing right now. Specifically perishables, produce, meat, dairy, the items that can't sit in a warehouse waiting for prices to stabilize. Diesel powers the refrigerated trucks that move those goods from farms to distribution centers to your store. A 36% diesel spike means the cost of transporting perishable food just went vertical. Supply chain researchers have confirmed that grocery stores will be among the first places consumers see prices rise outside of gas stations. The less shelf-stable the item, the more exposed it is. But retailers won't raise prices overnight. They'll absorb the costs for a while, just as many did during the tariff shocks of the past year. The problem is they've already been absorbing those tariff costs. There's almost no margin cushion left for a second shock. One economics professor at Boston College warned that if oil prices stay elevated for any meaningful period, businesses will face a persistent cost shock they simply can't absorb anymore. And when they stop absorbing, the sticker price catches up fast. Wave 3,
Food production. This wave won't arrive for months, but it's already baked in, and it should genuinely concern you because it operates on a delay that makes it nearly invisible until the damage is done. Fossil fuels account for up to 80% of fertilizer production costs. Iran, Qatar, Saudi Arabia, Bahrain, and the UAE are among the world's largest fertilizer producers. And 1/3 of the global fertilizer supply passes through the Strait of Hormuz, the same waterway that's currently shut down. Which means the food you'll be eating in September and October is getting more expensive right now because of inputs that farmers are paying a premium for this month. You won't feel this wave until fall. By then, it'll be too late to prepare for it. And by then, most people will have completely forgotten that the seeds of that price shock were planted in March. Wave 4, airfare. Jet fuel has surged roughly 85% since the conflict began. Qantas, SAS, and several of India's largest carriers have already announced airfare increases. Unlike gas prices, which fluctuate daily, airlines bake fuel costs into their pricing models months in advance. Those higher fares don't reverse quickly, even if oil drops tomorrow. If you're planning a summer trip, your ticket prices are about to hurt. Wave 5, interest rates. This is the one almost nobody has connected yet. The Federal Reserve was widely expected to begin cutting rates this year, which would have brought down borrowing costs on mortgages, car loans, and credit cards. That expectation is now dead. Some economists project the first rate cut won't happen until the third quarter at the earliest. If inflation accelerates further, rates could actually go up. If you were planning to buy a home, refinance, or take on new debt of any kind, the math just changed underneath you, and it changed quietly, without a headline. One leading economist put it this way: when inflation shocks collide with geopolitical uncertainty, consumers don't just cut spending, they freeze. They delay cars, homes, renovations, not because they can't afford them today, but because they've lost confidence in what they'll be able to afford tomorrow. And when millions of households freeze simultaneously, that collective pause can drag the entire economy down with it.
So let me ask you something. When you first heard that oil prices spiked because of the Iran conflict, how many of those downstream effects did your mind immediately connect? 1? Maybe 2? You're completely normal, and that normality is exactly the problem. There's a well-documented phenomenon in behavioral psychology called anchoring bias. When you encounter a complex, multi-layered problem, your mind doesn't process every layer simultaneously. It grabs the most visible data point and uses that as a stand-in for the entire situation. Right now, for most Americans, that anchor is the number on the gas station sign. $3.70, $4.20, $5.30, whatever it is in your area. That number has become the proxy for the entire economic impact of this conflict. And because it feels annoying but survivable, your internal threat assessment files the whole crisis under temporary inconvenience. Meanwhile, one leading economist estimated that the gas price spike alone could push monthly inflation to 1% in March, the highest single-month increase in 4 years. Annual inflation approaching 3%. And that's before the grocery shock, the fertilizer shock, the airfare shock, and the interest rate repricing ripple through every good and service that needs to move anywhere. The International Energy Agency called this the greatest global energy security challenge in recorded history. Not a moderate disruption, the greatest in history. And your anchoring bias is looking at the pump price, comparing it to last month, and whispering, "We'll manage." This is precisely what happened in 2022 after Russia invaded Ukraine. Gas prices spiked, people grumbled, then the shock bled into groceries, rent, services, everything. Inflation hit 9%. By the time most people grasped the full scope, the damage to their purchasing power was already done. You're not irrational for missing the pattern. You're running the same mental software as everyone else. But recognizing that software is the first step toward overriding it.
Now let's talk about what's keeping people up at night: your investments. The S&P 500 has dropped nearly 7% from its January peak, but the damage runs wider than any single index. The Dow just posted 4 consecutive losing weeks, its longest losing streak in 3 years. If you own index funds or target date retirement funds, you felt it. The Nasdaq briefly dipped into correction territory, falling nearly 10% from its high, dragged down by tech stocks that were supposed to be the growth engine of 2026. The Russell 2000, which tracks smaller companies more sensitive to interest rate movements, crossed officially into correction territory last Friday, down more than 10% from its January high. Energy markets are telling their own story. Brent crude surged to nearly $120 a barrel before pulling back to settle around $112 on Friday, its highest close since 2022. Gold, which many assumed would be the reliable safe haven, spiked above $5,400 per ounce and then crashed more than 10% in a single week, its worst weekly performance since 1983. Even the traditional safe plays aren't behaving the way people expected. Wall Street's fear gauge, the VIX, surged from the mid-teens to nearly 32. When volatility reaches that level, it's not just a number, it's a signal that professional traders are buying insurance against serious downside. When you absorb all of that at once, something happens in your nervous system. Your amygdala, the brain's threat detection center, starts screaming one word: sell, get out, protect what's left. This is loss aversion at work. Research from Princeton demonstrated that the psychological pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. A $5,000 portfolio loss doesn't feel like a $5,000 problem. It feels like a $10,000 emergency. Not because you're bad at math, because your nervous system evolved in an environment where losses could be fatal. That ancient wiring hasn't been updated for 401ks. But here's what actually happens when people act on that impulse during a geopolitical crisis. An analysis by RBC Wealth Management across 20 major post-World War II military conflicts found that the S&P 500 fell an average of 6% during the event itself. A separate study spanning 40 geopolitical events over 85 years found the average first-month loss was just 0.9%, followed by a 3.4% gain over the next 6 months. The pattern is remarkably consistent. The people who sold in panic locked in their losses. The people who held through the turbulence captured the recovery. During the market crash of March 2020, the S&P 500 recovered fully in 57 days. Then it kept climbing. Many of the people who sold near the bottom never got back in. They sat on the sidelines waiting for certainty that never came, while the recovery happened without them. And here's where it gets genuinely costly. The market's best days and worst days cluster right next to each other on the calendar. Miss just 10 of the best trading days over a 20-year period, and your total returns get cut roughly in half. Miss 20, and you barely beat inflation. You cannot capture the upside if you fled during the downside. Behavioral economists call this the behavior gap, the difference between what the market actually returns and what the average investor actually earns. That gap exists almost entirely because people buy when they feel optimistic and sell when they feel afraid, the exact opposite of what works. Not because they lack intelligence, because they're running ancient emotional software in a modern financial system. I'm not going to sugarcoat what comes next because there's a scenario that serious economists are genuinely worried about: stagflation. Rising inflation and slowing economic growth happening at the same time. It's the worst-case environment for your money because the tools that fight inflation, raising interest rates, also crush growth. And the tools that stimulate growth, cutting rates, pour fuel on inflation. There's no clean exit. The Fed is already trapped. At their most recent meeting, the Fed left rates unchanged because the war has made the path forward genuinely impossible to navigate with confidence. Cut, and you risk accelerating an inflation problem that's already growing. Raise, and you risk tipping an economy already buckling under energy costs into a full recession. If the conflict drags on and the Strait of Hormuz stays disrupted, some analysts project Brent crude could approach $130 a barrel. At that level, we're past inconvenience, we're into structural damage to household budgets, consumer spending, and corporate earnings simultaneously. The 1973 OPEC oil embargo is the comparison analysts keep reaching for, and it's not hyperbole. Every major oil price shock in the last half-century has been followed by some form of recession. The 1973 oil embargo triggered a 2-year economic contraction. The 1979 Iranian Revolution doubled oil prices and produced another. The 2008 oil spike preceded the financial crisis. The pattern is so consistent that some economists consider sustained oil shocks one of the most reliable triggers of stagflationary conditions in the modern era. And the current disruption, with production across Kuwait, Iraq, Saudi Arabia, and the UAE collectively dropping by at least 10 million barrels per day, is being described as the largest supply shock in the history of the global oil market. That phrase doesn't get used lightly. And even when this eventually resolves, relief won't be immediate. Economists describe what's called the rockets and feathers effect. Prices shoot up like a rocket when costs rise, but drift back down like a feather when they fall. After Russia invaded Ukraine, gas prices spiked within days. It took months for them to meaningfully retreat. After the hurricanes that devastated Gulf Coast refining in 2005, same pattern. The spike was immediate, the recovery was glacial. So even in the optimistic scenario, the strait reopens, oil flows resume, you're looking at weeks of ramp-up time for production infrastructure, months for prices to drift back toward normal, and a long tail of elevated costs rippling through every layer of the supply chain. The Strategic Petroleum Reserve release, 172 million barrels from the U.S. alone, the largest coordinated IEA release in history, buys time. It does not fix the rupture.
All right, deep breath. Let's talk about what you can actually control. Because the difference between people who come out of economic shocks stronger and people who come out weaker has almost nothing to do with what happened to them. It has everything to do with what they chose to do while it was happening. First, do not panic sell your investments. I know every instinct is telling you to move to cash, but research across multiple financial institutions consistently shows this is the single most expensive mistake investors make during geopolitical crises. One certified financial planner framed it precisely. Wars can last several years, but most people's investing time horizon is measured in decades. Moving 100% to cash doesn't eliminate risk. It trades market risk for inflation risk and opportunity cost. There's no risk-free option. Being too conservative is itself a risk because you can outlive your money. Second, pressure test your emergency fund. Financial advisors typically recommend 3 to 6 months of expenses in something liquid and accessible, a high-yield savings account, for instance. The top accounts are currently paying over 4%. If your cushion is thin, this is the moment to build it. Not because the worst case is guaranteed, but because the psychological security of knowing you can absorb a shock may be the most underrated financial tool available to you. Think of your emergency fund less as a savings account and more as insurance against your own fear response. The cost of not having it isn't just financial, it's the difference between watching difficult news and feeling concerned versus watching it and feeling desperate. Desperate people make expensive decisions. That calm is worth more than the interest. Third, audit your spending before the next waves arrive. Gas is already here. Groceries are coming. Airfare is coming. The interest rate repricing is coming. If you wait until all 5 waves have landed to adjust your budget, you'll be scrambling reactively instead of moving proactively.
Cut discretionary spending now, before you're forced to, and redirect those dollars toward financial cushion. Fourth, if you're investing on a regular schedule, keep going. This feels counterintuitive. Your gut says stop throwing money into a falling market. But this approach, investing a fixed amount every month regardless of conditions, is one of the most well-evidenced strategies in personal finance. When you invest a fixed amount consistently, you automatically buy more shares when prices are low and fewer when they're high. The volatility that feels terrifying right now is quietly lowering your average cost per share. Behavioral economists call this dollar-cost averaging. It works precisely because of the chaos, not despite it. The shares you accumulate during this period may turn out to be some of the best investments you ever made. The people who paused their contributions during past crises missed the discount and bought back in at higher prices. Fifth, map your specific exposure to energy prices. This one is personal and looks different for everyone. If you're commuting long distances, the economics of a more fuel-efficient vehicle just shifted. If you're carrying high-interest credit card debt, attack it now. The Fed isn't cutting rates anytime soon, which means your borrowing costs stay elevated longer than anyone anticipated 6 months ago. Every dollar of revolving debt you carry through this period is more expensive than it was before the conflict started. And if you own a small business that moves physical goods, your shipping costs just jumped. Now is the time to renegotiate contracts, consolidate shipments, or identify closer suppliers before diesel surcharges eat through your margins.
Here's the thing that actually separates people who come through periods like this financially intact from those who don't. It's not intelligence, it's not income, it's response time. Research on past economic shocks, the 1973 oil crisis, the 2008 financial collapse, the 2020 pandemic, the 2022 inflation surge, reveals a consistent pattern. The households that fared best weren't the wealthiest, they were the ones who adjusted earliest, who recognized the signals before the full impact arrived and made small, unglamorous moves, trimming discretionary spending, fortifying savings, maintaining investment contributions, reducing high-interest debt. None of those moves are dramatic. None of them make for a compelling social media post. Nobody shares the story of the month they moved $200 from dining out into a high-yield savings account. But that's exactly the kind of quiet, invisible adjustment that creates real financial separation between people who were ready and people who weren't. Compounded over the 6 to 12 months that an economic disruption typically takes to fully cycle through the system, those early adjustments create an enormous,